Welcome to the tutorial on managerial accounting. Today the chapter is standard cost and variances. Standards are benchmark or norms for measuring performance. That means if we want to measure performance, we have to determine benchmark or standard. Generally there are two types of standards. We can see quantity standards and the other one is price or cost standard. Quantity standards specify how much of an input should be used to make a product or to provide a service. That means quantity standard indicates what should be the amount to use in producing a product or providing a service. On the other hand, cost or price standards specify how much should be paid for each unit of the input. That means what should be the price or what should be paid, that is called price standard. So quantity standards indicate what is the amount we have to use. Price standard indicates what should be paid for producing a product or for using an input. So in this chapter we are going to find standards and variances for three items. First one is material. There will be two standards for material quantity variance and material price variance. Then we will find labor standard, labor efficiency variance and labor rate variance. After that we will calculate or find manufacturing overhead variance, overhead quantity variance which is called efficiency variance, and overhead price variance which is known as overhead rate variance. So generally variances are set by the managers, accounts manager, finance manager, purchase manager. Ultimately in this chapter we are going to find price variance and quantity variance. We will compare actual and standard. We are going to find the price variance for material, price variance for labor which is known as labor rate variance, and price variance for variable overhead which is known as spending variance. On the other hand, we are going to calculate the quantity variance for material, quantity variance for labor which is known as labor efficiency variance, quantity variance for variable overhead which is known as variable overhead efficiency variance. So in this chapter, if we want to find out the variances, we can use very simple formula. Here we can see SQ means standard quantity, here SP means standard price, here AQ means actual quantity and SP means standard price, AQ means actual quantity, AP means actual price. So if we multiply this SQ with the SP, then we will get a amount. After that we will multiply actual quantity by standard price, then we will get a amount, and if the result of this multiplication and the result of this multiplication, if we deduct these two amount, we will get the material quantity variance. So variance means the difference between the cost. So here we will get a cost and here we will get another cost. So if we get the difference by deducting both the amount, then we will get material quantity variance. And on the other hand, from this amount and this amount, if we compare both this amount, we will get material price variance. So after that, if we compare material quantity variance and material price variance, we will get material spending variance. So this is a very simple formula to calculate the material price variance. Again I am repeating here: standard quantity, standard price, actual quantity, standard price, actual quantity, actual price. By comparing this to one, we will get material quantity variance. By comparing this to one, we will get material price variance. And after that, by comparing material quantity variance and material price variance, we will arrive at material spending variance. So if we can know the formula for material variances, the formula for labor variance is same. So here whenever we are taking amount from the question, we have to keep one important thing is that whenever we are taking standard quantity, it is the total amount, and actual quantity is the total amount, actual quantity for total amount. But for price, standard price, it is per unit. Standard price it should be per unit, and actual price per unit. That means whenever we are taking the quantity, it should be for total amount, and whenever we are taking the price, maybe standard price or actual price, the price should be for per unit. Here we can apply the same formula to find out the labor variance. You can see there is a similarity between the formula. Here we can see standard quantity, here standard hour. So if we replace the quantity by hour, we will get the formula for labor variances. Notice that here standard quantity, here standard hour, here standard price. So in case of material variances we use price, but in case of labor variances we use rate. So the same formula, if you notice very carefully, you can see there is a similarity between this formula and this formula. So for labor variance, we are going to use the standard hour and standard rate. Here actual hour, standard rate, actual hour, actual rate. So there is a very similarity between both the formula of material variances and labor variances. Here we are using quantity, here hour, here price, here rate. So let's see the formula of labor variances. Here we can see standard hour and standard rate, actual hour, standard rate, actual hour, actual rate. So standard hour and actual hour, this hour should be for total production, but standard rate and actual rate is for per unit. Okay, so again same thing like the material variances. If we multiply this amount, and if we compare these two, then we will get the labor efficiency variance, which is also known as quantity variance for material, but in case of labor variances, it is known as efficiency variance. On the other hand, if we compare this one and this one, we will get the labor rate variance. In case of material variance, we can see there is a price variance. Here this is rate variance. If we compare labor efficiency variance and labor rate variance, we are going to get the labor spending variance. So this is the material variances, this is the formula for labor variances, and same formula can be applied for the variable overhead variances. There is zero difference between the formula. Here you can see standard hour, standard rate, actual hour, standard rate. So there is zero difference between the formula of labor variance and variable overhead variance. So here we can see standard hour, standard rate, actual hour, standard rate, actual hour, actual rate. So if we compare this one with this one, then we will get two amount, and if we compare this two amount, we will get the variable overhead efficiency variance, which is equal to the material quantity variance. Here we can see this is called efficiency variance. And on the other hand, if we compare this one and this one, then we will get the variable overhead rate variance. For material, this is called price variance. For labor, this is called rate variance. Overhead, for this is called rate variance. And if we compare these two amount, we will get the variable overhead spending variance. So these are the formulas to find out the material variance, labor variance, and variable overhead variance. But for doing the math, you have to keep in your mind, this is for total amount, quantity, and hour for total amount, price, rate for per unit. So we have seen the formulas. Now we are going to apply those formulas to solve the problem. Here this is a question. We will find out the variances from this question. So I am going to show the amount in the math. So here the question is, Xavier company produces a single product. Variable manufacturing overhead is applied to products on the basis of direct labor. This line indicating that variable manufacturing overhead, I mean overhead, depends on labor hour. Traditionally we do this. Okay, so again I'm repeating, overhead cost depends on the labor hour. So the standard cost for 1 unit of product are as follows. So here these are the amount given in the question for standard cost. So standard cost for 1 unit. So here the material cost, standard quantity 6 ounce, and standard price 0.50 per ounce. And here labor standard quantity or hour 0.6 hours, and standard price or rate $30. Okay, and for overhead, variable manufacturing overhead, in short here we will use the word overhead. So overhead standard quantity 0.6 hours, and standard price, I mean the standard rate, $10. So these are the standard costs. On the other hand, we can see during June 2000 units were produced. The cost associated with June's operations were as follows. So these are the cost for actual production. Again I'm repeating, here the amounts of cost or quantity or rate or price given for standard, but here the quantity or the price or the rate given for the actual production. Here the actual production is 2000 units. So this cost amount or this price amount or rate amount for 2000 units, that means these are the amounts for actual activity. Okay, so from this math we are going to find out or calculate or compute the direct material, direct labor, and variable manufacturing overhead variances. So this is the math. From this math we are going to find out the variances of material variance, labor variance, overhead variance. So let's see the solution. Again, welcome to the solution. Here we can see the direct material variances. The formula is standard quantity multiplied by standard price, actual quantity multiplied by standard price, actual quantity multiplied by actual price. So from the question we will get the standard quantity. So we can see in the question standard quantity. So here I have to mention one important thing is that here the cost amount, or here the amounts given are for the standard cost for 1 unit. So here we can see this is 1 unit standard cost. So for the purpose of solving the math, we have to calculate standard quantity and standard hour by applying this actual production. So here the actual production is 2000 units. For these 2000 units, we have to multiply this 2000 with this material standard quantity to get the standard quantity of material, and we will multiply 2000 actual activity with the standard labor quantity to get the standard quantity for labor, and we will also multiply this 2000 with this standard overhead hour to get the standard quantity for hour. So again I am repeating, for solving the math we have to calculate the standard quantity for material, labor and overhead by multiplying this actual activity. Actual activity and standard quantity and rate should be multiplied to get the standard quantity and hour. So let's see the solution. Here we can see the standard quantity is 12,000 units. So how to get it? On the question we can see the actual activity is 2000 and material standard quantity is 6 ounce. So if we multiply this 6 ounce with the 2000 units, we will get the standard quantity of material. So the standard quantity of material is 12,000. Here we can see 2000 units and 6 ounce per unit, so 12,000 units. So here the standard quantity 12,000. Again, then we can see standard price. So from the question we can see the standard price of material is 0.50 per ounce. So standard price 0.50 per ounce, and here again standard price 0.50 per ounce. Then actual quantity. So from the question we can see actual quantity, these are the amount of actual activity. So the actual quantity for material is 18,000 purchased and used 14,000. So there are two quantity. So there are two material quantity. One is purchase amount, another one is used amount. Whenever we need to find out the quantity variance, we have to use the used. So here the material used amount is 14,000. So again I am repeating, whenever we are calculating the quantity variance of material, we have to use the actual material used. So this 14,000 is the used, but whenever we are calculating the price variance, then we have to use the purchased amount. Here the purchase amount is 18,000. So this is the 18,000. So actual quantity. Okay, so whenever we are calculating price variance, we have to use the actual material purchased, and whenever you are calculating the quantity variance, we have to use the actual material used. So again, actual quantity 18,000 units or ounce, and actual price is 0.60. For the question we can see the material price actual 0.60 per ounce. So in the solution we can see, if we multiply the standard quantity 12,000 with the standard price 0.50, the amount is 6,000. On the other hand, the actual quantity is 14,000 ounces and standard price 0.50. If we multiply this 14,000 with the 0.50, we will get the 7,000. So here the amount is 6,000, here the amount is 7,000. So to get the quantity variance, we have to compare these two amounts. So the difference between 7,000 and 6,000 is 1,000. So here whenever we are calculating the variances, we have to show whether it is favorable or unfavorable. So whenever we are comparing favorable or unfavorable, we have to consider this amount as the standard. So this one and this one, whenever we are comparing these two, this one is the standard. Okay, again for the price variance, we have to use the purchased amount. So here the purchased amount is purchased amount of material is 18,000 ounces, and per unit standard price is 0.50, and here the actual quantity is 18,000 purchased amount, and the actual price is 0.60 from the question. So here the amount is 9,000, and here the amount is 10,800. So if we compare both this amount, or if we calculate the difference between these two amount, the amount is price variance. So here the amount is 1,800. So whether it is unfavorable or favorable, in that case this is the standard and this is the actual. So here the standard cost is 9,000. That means cost should be 9,000, but actually the cost is 10,800. So there is a higher cost, so this is unfavorable. Here you can see this is the 6,000, this is standard, and this is the actual. So standard, that means the cost should be 6,000, but actually it was 7,000. So there is also unfavorable condition. These are the amounts of material variances. The quantity variance 1,000 unfavorable by comparing this one and this one, and the price variance is 1800 unfavorable by comparing this 9000 and 10800. So now we are going to find out the labor variances. So here the formula is standard hour multiplied by standard rate, actual hour multiplied by standard rate, actual hour multiplied by actual rate. So standard hour. So from the question we have to find out the actual hour. The question is the labor hour 6 hour per unit. We have to multiply this 2000.6 hour to get the labor standard quantity. That means labor hour standard quantity or standard labor hour. So if we multiply this 2000 with the 0.6 hours, we will get the standard hour labor, and the standard rate is 0.30. From the question we can see the labor. This is the standard quantity. So if we multiply this 1200 hours with $30, we will get the amount 36,000. And here the actual hour. From the question we can see the the direct labor hour 1100 hours. So this is the actual hours. Already we are aware that these are the information for actual activity. So from this actual amount, the labor hour is 1100 hours. We can see this is 1100 hours, and the standard rate we already have seen that the standard rate is labor 0.30. So this is the standard rate, and actual hour same here 1100 hours, here 1100 hours, and actual rate from the question we can see the actual rate is labor 30.50 per hour. So this is the actual rate. So $30.5. So 30.5. So if we multiply this 1200 hours with the 30, the amount is 36,000. And here 1100 hours, 30 is the standard rate. So the amount is 33,000. So if we compare this one with this amount, then the variance is called the labor efficiency variance. So if we compare 36,000 with the 33,000, this is the standard. Okay, the standard cost should be 36,000. Actually the cost is lower, so this is favorable. So 3,000 favorable cost. So labor efficiency variance 3,000 favorable. On the other hand, if we multiply 1100 with the 30.50, the amount is 33,550. So if we compare this one with this one, then this 33,000 is the standard. So here the standard cost should be 33,000, but actually it is higher, 33,550. So this is unfavorable. So if we deduct if we compare both this amount, the difference is 550. This is unfavorable. This is called red variance. Okay, so very simple, and we can see then finally we have to compare this 3,000 with this 550. So here this is favorable amount, here this is unfavorable amount. So if we compare, so we have to deduct it, because this is the opposite amount, favorable and unfavorable. That's why we are deducting these two amount. So the difference is 2,450, and this is the higher amount, this is favorable. That's why this 2,450 is the favorable amount. So if this is favorable and this is favorable, we have to add both the amount. Again, if this is unfavorable and if this is unfavorable, we have to add. But since there is a opposite, favorable and unfavorable, we have to deduct or minus both the amount to arrive at the spending variance. So this is the labor variances. This is labor efficiency variance, this is labor rate variance, and this is the spending variances. Now the last one, variable manufacturing overhead variances. So the formula is very same as like the formula for labor variances. Here we can see standard hour multiplied by standard rate, actual hour standard rate, actual hour actual rate. So standard hour, from the question we can see labor standard hour 0.6 per unit, and for 2000 it would be 1200 hours, and the standard rate on the question we can see standard rate is $10 per hour. So this is the standard rate. So here the standard rate is 10, again here standard rate is 10. Then we have to calculate the actual hour, but in the question we can see there is no actual hour. Although labor hour is 1100, but here we can't see any amount for actual overhead hour, but we are already aware from the question that here we can see variable manufacturing overhead is applied to the products on the basis of labor hour. So labor hour and overhead hour is same. So here labor hour is 1100, so overhead hour would be 1100 hours. So the actual hour is 1100, here actual hour 1100 hours, and the actual rate 11.80. From the question we can see there is no amount. We can also calculate this amount. Here the total cost is actual. This is the actual cost 12,980. This is the actual total cost for overhead, and the actual hour is equal to the labor hour 1100 hours. So if we divide this 12,980 by the 1100 hours, then we will get the actual rate for 12,980. This is the actual cost and this is the actual hour. So the rate is 11.80 per hour. So this is the actual rate. So this is actual rate. So now we will multiply 1200 hours $10. So the amount is 12,000. Here after multiplying the amount is 11,000. So if we compare this one and this one, so the standard is 12,000. So the cost should be 12,000, but actually there is a lower cost. So this is favorable. So what is the amount of favorable? If we deduct this two amount, the amount is 1,000. So this is called variable overhead efficiency variance. In labor we call it labor efficiency variance, and here this is called variable overhead efficiency variance. But although the name is different, but same. On the other hand, here we can see the amount is 11,000 after multiplying these two amount, and here the amount is 12,980. If we compare these two amount, this is the standard. So the standard cost should be 11,000, but actually the cost is higher, 12,980. So this is unfavorable. So what is the amount? 1,980. This is unfavorable. So here favorable, here unfavorable. If you compare these two one, we will get the spending variance. Since there is a opposite amount, favorable and unfavorable, we have to deduct. So after deducting, we will get the 980. So this is unfavorable because this one is the higher one. Again I am repeating, if this is favorable and if this is also favorable, so we will add both the amount. Or if this is unfavorable, if this is unfavorable, we will add both the amount. But this, since there is a different amount, favorable and unfavorable, we will deduct. So this is the spending variance of overhead expenses. Dear audience, we have done the math. We have solved the problem by using a diagram, but we can apply equation formula to get this. Here we can see we have this is the labor variances. So standard hour, standard rate, actual hour, standard rate. So we have compared and find out the labor efficiency variance 3000. We can do it by applying a simple formula. Here we can see labor efficiency variance, actual hour, standard rate, standard hour, standard rate. So you can also solve this problem by this equation method. You have to keep in your mind that whenever you are deducting this one and this one, maybe you will get minus figure. So you don't think that this is minus figure, okay? You have to keep this is not minus figure. Just you have to find out the variances. So if the actual is higher than the standard, that will be unfavorable, and if the actual is lower than the standard, that will be favorable. So minus figure should be avoided. Just you have to keep in your mind which one is higher. If the standard is higher, actual is lower, then as a cost, lower cost, it will be favorable. And if the actual cost is higher comparing to the standard cost, then it would be unfavorable. So you can apply formula like this, or you can do a diagram. So whatever your choice, you can apply this. Thank you.